Welcome back to another video for HarborFinancialOnline.com. Today I'm going to be talking about capital gains tax on real estate and to let you know if you owe tax on any real estate you've sold. So I'm going to get the video going here and try to explain this in a way to make it easy for you guys to understand out there, since a lot of you don't know if you sell property, what the tax repercussions are on it. So most likely, if you sold your home, you're not going to owe any tax. There are limits on how much money you can make on selling a home, and then you do have to pay tax. So what the limit is if you had a gain on your house when you sold it, if you're a single filer, not married, you can have profited $250,000 on the house and not pay tax. So anything under the $250,000, you won't have to pay tax, but anything above the $250,000 you will. And you'll have to report it on your tax return. Now if you're married, you get double the amount. You'll get $500,000 that you can make without having to report any tax. So it's doubled if you're filing a tax return married jointly. That's where the $500,000 exclusion comes in. Now these are exclusions amounts set by the IRS, and whatever state you're in should normally follows the same rules on that, so that shouldn't be a concern. Make sure to keep good track of all your home improvements, any of the cost over the time you own the house, because what happens is when you sell that house, any cost that you put into the home can be added to the total cost of the house, which means a lower profit. But make sure you have the documentation of all those costs. Total those up, put it together in a spreadsheet and see what your capital gain is. But keep track of everything. I mean, you can go all the way down to the little maintenance, to lawn care, to anything like that, that you put into your house to improve it. That's going to be costs that you can deduct when you sell the house. Now here's a quick example, just to try to make it a little more understandable for you guys. Say you paid $200,000 for your home. You spent, over the time you owned it, $20,000 in home improvement costs. Now you can see on the slide here, if you're not following, you sold the house for $465,000. Now you add the $20,000 of the cost in home improvements to what you paid for the home, $200,000. Now your total cost for the house is $220,000. Your profit is $245,000, because you'll take what you sold it for, $465,000, okay, minus the $220,000. So your profit is $245,000. So if you're a single filer, you're not going to owe tax. Now if you're married, again, you get double the amount of the exclusion. Now vacation homes and rental homes do have a lot of different tax rules on selling them. Number one with a vacation home is when you sell that, there's no exclusion amount. If you have a profit on a vacation home, you're going to pay tax, or a second home, or any kind of home that is not considered your primary home, you're going to owe tax on that if you had a profit. But you can have a loss on houses and report the losses, which is a good thing, because what you can do is, if you sold a house, a secondary home, not your primary home, you had a loss, then say if you owned several other houses and you sold one of those and had a profit, you can offset that profit with the loss, is how that works. Now with rental homes, what happens there is each year you report your rental home on your tax return, and you should be depreciating the cost of that home. So you're depreciating it, and it's technically a rental home is a business. So when you sell that rental home, that's fully taxable, the gain on it. So you have to report the sales of all rental homes. Now, the one thing that a lot of people don't realize right here, say you had a big lot that you live on, you divided it and sold it, you're going to owe tax on that even though that was your primary home, you're going to owe tax on whatever amount you subdivided and sold. Now, all property sales that you're reported that are above those exclusion amounts, the 250 if you're single filer, married jointly 500,000. If you have a gain above those amounts, you're going to report it on Schedule D. Okay. Now this gets attached to your regular 1040. It's just a one page form that you fill out, and it'll put in the property sales on there. Now I want to show you real quick our site, HarborFinancialOnline.com. You can prepare the return directly online here, and what you can do here is learn a lot more information about other credits and deductions, and if you sold that property, you'll be able to enter that in when you complete the return. I'm going to scroll down here. We have the free estimator calculator. Allows you to put in for free the amounts that you had in your taxes, say with the capital gains, if you sold the property. Put it in there, see if you owe any tax, see if you're required to report it or not. Because if you're under that exclusion amount, it's going to tell you you don't have to report it. And you can see on the left here some of the other credits that you might qualify for. The child care tax credit, the earned income tax credit, all the deductions for homeowners. So that's a big one there. It's going to cover all the different areas. Here's we have a whole page dedicated to capital gains tax law, and we explain it basically in the way that I just did, so you can go through and check that out. And all these pages, like I said, are focused on different areas of tax, all the credits and deductions that are out there. So let's get back to the video here. So again, check out our free online tax refund calculator. This will allow you to put in the information, see what your refund might be, or if you might owe tax. I appreciate you watching the video. Prepare your taxes online this year at HarborFinancialOnline.com, and hopefully you'll check out some of my future videos. Thank you.